Yeah, and he replaced Sam Pitt. Sam Pitt has moved to national accounts. So they come out and they gave us some orientation about Columbus Life. And there are two groups of people in my agency. They're very familiar with the Columbus Life. They've been doing business with the Columbus Life for a long time, so they know ins and out of Columbus Life. And there are other groups who are not exposed to Columbus Life. So I thought this was a good refresher. So let's go over some of the things they taught us that day. So Columbus Life is a member of Western and Southern Financial Group, one of the strongest mutually held insurance group in the world. So I think Western and Southern has made it to Fortune 500. So that's a big names. Uh, but they're not a stock company, they're a mutual company. So they don't have a stockholder. So if your insurance company is a mutual, that means you don't have a stockholders meeting. So you only talk to your policy owner is in a way they're the owner of the policy, owner of the company. So they're normally National Life is also mutual company. So in my 30-year experience, it's better to work with a mutual company than stock companies because stock company, they tend to change a lot. For instance, one of the example that I can give you is ANICO, American National Insurance Company, used to be owned by Moody family. It was a private company, so in a way, it is a mutual company. So they had annuities and life insurance and pension, and the ANICO was purchased by private equity group. I guess it's called BAM Brookfield. What is it? What is it? American Marketing or something like that. And once they took over, guess what happened? Now, ANICO no longer doing life insurance business. They no longer doing pension business. Only thing they're doing is ANICO. So it might be a right move, but the thing is, you and I, what if we had a life insurance client? It'll be an awkward situation. Okay. Pension, I don't know whether I should transfer those 401k clients and defined benefit clients and things like that. So that's something to think about. Rarely this kind of things happens with a mutual company. It is very frequent with stock companies. Okay. This is a Cincinnati. We've been to Cincinnati. Okay. Um, I few years ago, Columbus has invited Epi-Digm agent, and they had a training just for us. It was fun, right, Albert? Yeah. Yeah, this is the downtown Cincinnati. We've been there. That big building with the arch on the top, that's a Great Western building that's owned by Western and Southern.
Oh, really?
Yeah, yeah, it's that's where the Lafayette office is, and that's where Great Western Insurance Company was. I don't know whether it's still true, but that's. Remember, we went to Lafayette also, so we went to that building also. So Western and Southern goes back 1888, Fortune 500 companies, and they're a very strong company. Okay, they're financially well, uh, very stable company. Okay. So these are the numbers. I don't know. That number doesn't really mean a thing to me when it's that big. But one thing that you have to think about is the capital to asset ratio is of 14.6.
Yeah.
That means they have enough cash to weather the storm. Okay. These are the family-owned companies within Western and Southern. Okay, Western and Southern Life, Columbus Life, Eagle Realty Group, uh, Gerber's, and all that. So they have all this company, and we mainly deal with the Columbus Life and Lafayette Life, but we are kind of going away from Lafayette. But
Yes.
okay. So independent companies, Columbus Life, Lafayette Life, Gerber Life. Columbus Life, their focus is on index UL. Lafayette Life, their focus on whole life. And Gerber Life, their focus on guaranteed life insurance and some niche product like accident insurance and things like that. College savings plans and things like that. We have contract with all three. Going to Columbus Life, their IUL product is a very straightforward and realistic. So they're best known for accelerated death benefit rider, which is a living benefit rider. Okay, if you look at their illustration, you'll love it. It's not discounted method, it is a lean method, so client know exactly what they're getting, unlike discounted method. And since Columbus Life is under the umbrella of big corporation, but it is small company, you get personalized service, and their products are really, really good. And another thing that I like about Columbus Life is because it gives you their target premium is high for number one. So that means higher commission for the agent. And their product is a very simple, not complicated. And a lot of times what we have seen is that when they make an enhancement on new product, they try to apply that change, enhancement to the current policyholders as well. So that's a very big thing. It's a very straightforward company. So top tier compensation, high target, unlimited rolling target. That means if client is paying less than target first year, they'll still pay first year commission until client's payment reaches target premium. And their targets are high, as I told you. And 12-year renewal and excess commission. So you get excess on the excess commission premium. Excess commission premium means more than target premium. You get commission on that. And the renewal premium, that means after your target premium, you get commission on that also. And they have a lifetime trails. Trail commission is a commission on asset, which is a cash value. As the cash value grow, your commission gets grow, and that goes lifetime of the policy. Not that many company pays trail. I guess that's end of their slide. And let's go to their illustration. So if you go to Columbus Life, and if you're not an agent as of Columbus Life yet, go to guest login. And it is asking for the passcode. Passcode is C Life, Columbus Life, C Life, LIFE, all small letter. And let's go to Life product. Okay. Let's look at the illustration that I have created. No, oh, that's right. This is not mine. I just realized that. So create an illustration, create a new client. So John Doe. One thing you cannot do on this site is that you cannot save case, right? Let's say John Doe is 50 years old. Since it is John, let's put him on male. Okay, so California. So we'll do the universal life. And in universal life, you got all this. Index explore now, index plus. I think I want to stick with the plus. Now is a simplified, so if your client is healthy, I think it's better to go with the Explore Plus. Explore Plus UL is just traditional. Index Explorer Plus is Index UL. Voyager is a guarantee UL. Okay, click on that and next. Okay, so let's 50, let's put them in the preferred non-tobacco. Okay. So let's say your client wants $1 million face amount. And premium, you're looking for, and let's do the search for, so for premium. So what this will do is that the computer will calculate the premium amount to keep the policy going, $1 million death benefit going until age 120, right? The target, their solving target is cash value at age 120 is 10,000. So it's looking for minimum amount. So premium, you pay until age 120, or you can pay until age 70, right? Whatever you want to do. And let's say you want to do annually, semi-annually, quarterly, or PAT. PAT is a monthly automatic, okay? So if you do that, okay, and let's say financial report, rating reports. So this is one of the good sales piece, right? It tells you about the company's financial stability. And rider, if you look at the rider, you get accelerated death benefit riders, which is given, right? If your client may not be qualified for this, maybe they will have this, okay? Depending on the states and things. Sometimes it only has a terminal illness, but if they're healthy enough, they get all three rider, critical, chronic, and terminal, okay? So let's put another sales piece, understanding Life Plus rider. Okay. You also have an option of accidental death benefit rider, change of insured rider, children insurance rider, disability credit riders. Enhanced cash value rider is something for you to think about. Okay. Enhanced cash value rider, it eliminates surrender charges. Client do not have to pay surrender charges at all. So whatever this cash value is, that'll be your surrender value. And one good thing about Columbus Life's enhanced cash value rider is that you don't have to be on a pension plan to have enhanced cash value rider or premium financing to have a cash value rider. Because the company like Corebridge, if you want to waive surrender charges for your clients, it has to, it can only be, they can only issue it with, I, I think I'm correct, premium financing cases or pension cases. If not, they don't allow it, but Columbus Life, it is up to you or as an agent or as and client to choose enhanced cash value rider. Another good thing about this is that they pay target premium per share. They don't spread the commission over 5 or 6 years, unlike other company. Like National Life, if you choose that riders, they call it different riders, but if you use enhanced cash value rider, it's spread over 6 years. But this one, you get lump sum. Okay. Another good thing about Columbus Life, when we ask to be annualized on the commission, they annualize 100%. Whereas almost all other company, they annualize only for 75%, which is a 9 month. Okay. You get to have other insured term rider, but I normally do not choose riders, so that's about the riders that I would choose. Cash flow, I mean, if you want to solve for cash flow, you can actually have it. So let's look at the values. It just gives you a snapshot. As you will see, cash value and surrender value is the same from year one. I love this. Well, I guess maybe I should not say I love it. I kind of like it, but it opens up little challenges. client has no incentive of staying with you. Okay? If client decide to leave, a lot of times they're kind of locked in because of the surrender charges. But with this enhanced cash value rider, they're free to go, at least in terms of surrender charges. And because of this thing, it is not only put you in a jeopardy, but it also jeopardize insurance company as well. So insurance company is looking for a longer outlook. That's why they pay you commission. So what they'll do is that they put a chargeback period and they extend it to 5 years. So instead of 1 year's chargeback, we're looking at 5-year chargeback. That's the one downside about having enhanced cash value rider. And that's true with almost all insurance company. And I don't mind. I think I don't want to prison my client. Okay. So that's the type of deals that you will see. Okay. So let's look at the reports. You can have a report selection. So you got all kind of report selection. So one thing I normally put is a simplified ledger, not the graph, but where is it? Simplified ledger, so that it'll just it'll have a easier section for me to explain. And I also put expense, universal life supplemental expense chart there, if the client is tacky like me. Okay. And let's say you create a preview illustration. Okay, here's the illustration. So it tells you they bump it up, they made it a little nicer looking than before. Okay. So unexpectedly pass away, premature death. I think I like it better than other way of saying it. Premature death and need supplemental income, okay, living too long, and become ill. So it covers 3 life incidents. Okay, focusing on life insurance. This looked just like a national life. Yeah. I think that's what they meant when they brought in a national life actuary. Okay, that's what the Columbus Life people said when they're giving us training. My policy begin when I pay $1,473.69. And so the death benefit is a 1 million. Supplemental income, this is a cash value on 50 and on age 55, 42,000, 65, 197,000, 75, 416,586. This can be accessed tax-free via policy loans and withdrawals. And here are the living benefit at age 55, 65, 75, 85, chronic illness, critical illness, terminal illness, and this is the amount that you can get. And there is no discounted method involved. So remaining balance is remaining on that benefit. Okay. So that's Columbus Life. Oh, it doesn't show target premium, Albert. This is the no, I think it's because it is the demo. Oh. Okay, if you use your own agent numbers, it'll tell you. I don't know, maybe this is target. Okay. Looks like. Yeah, looks like it. So it has all the language, legal languages, and I don't want to bore you with the legal language for now. We can have separate time to go over all this. So if you look at this, here are the policy loans. There are 2 loan options: participating loan versus standard loan. Participating loan, when you take a loan, your money still stays within cash value, so it is experiencing the growth of the cash value. Okay, so it can be high, low. I mean, so their interest rate is a 6%, right? So let's say policy the cash value experienced 0% growth because S&P wasn't doing that well. then that year your interest, the loan interest is a 6%. On the other hand, if it went up 5%, you get 6%. So it all depends on, I guess, the situation, what is your index is doing. So non-guarantee loan interest is a 5%. Guarantee interest rate, the maximum interest they can charge is a 6%. I like their guarantee. Okay, so you cannot go over 6%. And standard loan option is different. It is a 2.5% and 2%. But the amount of money that you're taking a loan will not stay in cash value. It'll go to loan reserve account and getting a fixed interest rate. The fixed interest rate is a 2%. Okay, so the loan interest for first 10-year is a 2.5. Guarantee interest rate is a 2.5. The credit is a 2%. Then your loan interest is a 0.5, right? But you can have their current practice is that the loan interest becomes 2%. That's non-guarantee. So worst they can do on the loan is a 2.5. So you might be charged with 2.5. I mean, not 2. Well, loan interest is 2.5, but since they're taking hostage of your loan amount because they took out from your cash value, it also get interest rate of 2%. So in a nutshell, what we're looking at is that in current practice of insurance, Columbus Life, first 10-year, your loan interest rate is net of 0.5, right? And starting on 11th year, your net interest rate is 0. It becomes wash. But in terms of the worst case scenario, which is a guaranteed scenario, on the guaranteed scenario, your interest rate for first year is a net of 0.5. And starting in the 11th year, it is also
11 o'clock.
0.5. So that's a worst case scenario. So the client has option of either go with a standard loan option, or if they think the index will be doing more than 6 or 5%, they can do index option, the participating option. Okay. Okay, their current cap on S&P is what? Do they have a current cap? Okay, no. They don't have it. Okay, they don't show it to you. Oh, it shows 10.75. Not bad. 10.75.
That's cap?
Yeah, that's a
Oh,
cap.
not bad.
So from 2020 to 2024, if it was a 10.75, we're looking annual average of 7.53. 2015 to 2024, which is 10 years, 7.334. So interest rate is really good. They also have uncapped annual point to point with the spread. We're looking spread of 3%. No, threshold of 3%, spread of 7%. Yeah, it got a little better, but I don't know. Okay, if you think that index will do more than 7%, that might be an option. But if you look at last 5 years, with that, we're looking annual average of 12%. Last 10 years, 8%. Last 20 years, 7.75. So last 30 years, 8.65. So not bad. The best, highest index possible with this assumption is a 50.63%. That's unrealistically high, but it did happen in the past. Yeah, it doesn't say when. So that's one interest rate. And here's another one. This one shows 20 20 years annual interest rate, year by year, with the assumed cap rate and assumed spread rate. I'm not really into monthly averaging. Okay. And you also have JP Morgan's balance index. Last 5 years, 5.86. Last 10 years, 8.97. Last 20 years, 10.08. Highest, 35.25. Not bad. Okay. And their annual rates right here. I think with this high S&P, I think I stay with S&P. Okay. And here's the 0 and 0.34 and 6.68. The illustration, okay, midpoint, guarantee midpoint and non-guarantee. Hopefully you know what it is now, right? And we should have something coming up soon, right? Living benefit. I'm looking for living benefit. That's the beauty of this thing, okay? Beauty of Columbus is right here. You're $1 million. If you have if you're hit with a chronic illness, and if you decided to take half of 1 million and make a payment over 3 years to 10 years, depending on how you want it, you get to have up to $463,000. Remaining 500,000 remains in the death benefit. Okay, there's no discounted method. Then if it is not a discounted method, how are they going to charge interest? Your remaining death benefit will be decreased by annual interest. If you want to take a lump sum, you can have $239,000 from 1 million for one lump sum. And if you die within a year, you get $742,000. You get to leave behind to your beneficiary. Okay. If it's a critical illness, 30,000 is a maximum you can take. And if you die within 12 months, $967,000 remaining death benefit. Terminal illness, 239,000 and 742,000 is a remaining death benefit. And year by year, you get to know exactly what you're getting. There's no actuarial underwriting here because you pay interest as you go. And what else is here? And this is where I like the simplified ledger, Albert. It tells you just with the 6.68%, here's how much premium you have paid, and here's how much cash value, surrender value you have. Because we have enhanced cash surrender value, surrender value is a cash value. So after 20 years, your cash value is 336,000. Not bad. Okay. All right. And here's company ratings: AM Best A plus, Standard Poor AA minus, Fitch AA, Moody's AA3, Comdex rating of 95 of 100. They're lagging up. Before we do first, it was 97. Now they're 95. I'm just joking. 95 is really, really good number. Okay. And this is what I like to show to the client who has a lot of question. If you put $17,000 in, first thing they'll take out is a 1,400 from as a front charge, and remainder will go to the cash value. From the cash value, $722 will be deducted for the cost of insurance for that 1 year. And there's another optional riders. This is probably enhanced cash value riders. We only have that rider, right? So $2,160. So if you don't like that, you can remove it. That means there's going to be surrender charges. But I think this is a minimal. I think this should be there. An expense charge of 5,778. This is what we call for per $1,000 charges, and it lasts 10 years.